Hello traders, I'm Luke from Disciplined Trader. This video is part of the Trading Basics series, and in this one I want to introduce you to some of the most commonly known price patterns. We'll look at what the patterns look like, what each tends to be indicative of, and the rationale behind each indication. Before we dive in and start looking at some price patterns, I want to quickly discuss why price patterns are used in trading. I think a lot of traders think that patterns only work if they meet a long list of criteria, and that if they meet that list, they mystically make price move to a certain level. But the truth is that patterns work because they give us an insight into the mentality and sentiment of the market participants, i.e. us, the traders trading that particular market. If a trader can gauge the overall sentiment of a market, it can give them a good indication of where the market will likely move next. Some patterns may also have a sort of self-fulfilling prophecy behind them, particularly those that are very easy to spot. What I mean is that because so many traders spot a particular pattern and think a move is likely to happen, they actually cause it to happen by acting upon that analysis. When trying to identify patterns on your chart, it's definitely worth thinking in this way rather than bluntly trying to pick out patterns and entering the trades off the back of them. Ask yourself, what does this price pattern tell me? With that in mind, let's start looking at some common patterns, and let's kick off with double tops and double bottoms. Double tops and bottoms form when price makes either a swing high or a swing low, pulls back, and then revisits that swing high or swing low, and fails for a second time at the same level. This leaves us with a double top or a double bottom at the same price level. These patterns tend to be indicative of a reversal, as price has attempted to move past a certain price level and failed on 2 attempts. This can show that the buyers or sellers, depending on whether it's a double top or bottom, are starting to outnumber their opposition at this level, and so the price may be due for some sort of reversal. This leads us on to triple tops and bottoms. There's not much to add here, as triple tops and bottoms work on the exact same principle as double tops and bottoms, only this time there are 3 failures at a particular price level. It's worth mentioning that the price doesn't have to fail at the exact same level for this pattern to form. Technical analysis is an art, not a science. Rarely do any patterns form in a textbook-like manner. Like we discussed earlier, it's more about what the pattern is showing you about the market sentiment than it is identifying a textbook pattern. Let's move on to the head and shoulders pattern. The head and shoulders is another pattern that tends to indicate that a reversal may be imminent. This pattern creates a high, pulls back, then creates a higher high, before pulling back again, and then creating a lower high. The resulting price action leaves us with this pattern made up of a left shoulder, head, and right shoulder. Similar to double top and triple top patterns we just looked at, the rationale behind this pattern is that price has been moving upwards, pulling back and creating a higher high. So far, so good for a further move higher. However, when price fails to even make it back up to the previous high, never mind break past it, this is considered a strong sign of weakness. So traders who like to trade this pattern will typically enter a trade when the price starts to fall again and breaks past the point they call the neckline, which is the 2 low swings at either side of the head. The inverse of this pattern can also be used and is fittingly called an inverse head and shoulders pattern. It works in exactly the same way, apart from the inverse pattern is indicative of a reversal to the upside. Now let's have a look at triangles. Triangle patterns typically appear in periods of consolidation within trending moves. There are 3 main types of triangle patterns. We have standard triangles, ascending triangles, and descending triangles. All these patterns share one important characteristic, as you can see from the illustrations, and that is the price range within each is squeezing to a point where a break to either the upside or the downside is inevitable. This is the reason why these patterns are so appealing to traders, because traders are expecting a break one way or the other. It gives them various opportunities to trade that move when it happens. Some traders like to trade the breakout itself, while some traders look to get in on a retest of the triangle structure once the break has happened. Ascending triangles tend to occur during an uptrend as price reaches a resistance level and has a few attempts at pushing past it whilst having a shallower retracement each time. This is generally seen as a bullish sign, and traders typically look for the break to come to the upside. The opposite is true for descending triangles, as these are generally thought to show bearish sentiment, and so look for a breakout to come to the downside. As you may have guessed already, standard triangles don't really have a bias. Traders simply wait to see which direction the price will start to break. Now let's move on to channels. Price channels appear in both trending and ranging markets, and are identified by an upper and lower boundary. A trend channel will be made up of two parallel diagonal lines, between which the price will be bouncing whilst either making progress to the upside or to the downside, depending on whether the market is uptrending or downtrending. Traders like to use these to keep them in their positions as the price continues to make progress in the direction of the trend. A trader may use a break of a channel as an exit signal, as this is an indication that the strength of the trend may be weakening. Some counter-trend traders also like to trade the break of a trend channel because of that same thinking. They want to get in on any potential short-term retracements to the trending move. A range channel is made up of two horizontal lines between which the price will be moving in a sideways fashion, without making any significant progress to either the upside or the downside. Hence, this is referred to as a trading range. Traders that like to trade range-bound markets look to enter a trade when the price is near or at its lower or upper range boundary. They work on the rationale that the price will likely continue within its range and so will likely reverse from this boundary. Some traders will rather take a trade on the break of an identified range, so they will wait until the price either breaks past the upper or lower boundary. The thinking behind this method is that because the break of a range boundary is a significant indication of strength or weakness, depending on whether the price has broken down or up, there will likely be a good amount of follow-through to the move. Lastly, let's have a look at harmonic patterns. Harmonic patterns use geometry and mathematics to predict very precise movements in the markets. They incorporate Fibonacci retracements and extensions to predict how far a market will likely move in a given direction and also at what point a reversal may likely happen. A good example of a harmonic pattern is the Gartley pattern. This pattern is used to predict where a reversal will likely take place and can be used for bullish and bearish moves. The pattern requires points X, A, B, C and D to form at specific points in order for the pattern to be valid. Each point is forecast using either a Fibonacci retracement or extension of the previous move. If all of the points form according to the rules of the pattern, then the trader can look for the reversal to occur at the D point. You can see the attraction of trading in this way as there is little room for any ambiguity. The pattern either forms according to the rules or it doesn't. However, like other patterns we've looked at, there is still an underlying rationale as to why this pattern works. Essentially, traders are looking for a retracement of an impulsive move in one direction before looking to trade in the direction of the original move. There are also other harmonic patterns including the butterfly, bat and crab patterns. That covers the overview of some of the most commonly used pattern types, but I just want to add that before you include these into your trading approach, if you are thinking of doing so, please make sure you spend some time with historical charts and backtesting the patterns you are thinking of using. Like I said earlier, these patterns rarely form in a clean-cut, textbook-like manner, and so spotting them isn't as easy as you might think, especially in the live markets. So that wraps up this introduction to price patterns. I really hope you found it useful. If you have enjoyed the video, please feel free to drop a like on it. If you have any questions or want me to cover any other topics in future videos, please let me know in the comments below. Also, subscribe to the channel for more videos like this one. I will be continuing this Trading Basics series to provide new traders with all the knowledge they need to get started. Thank you very much for watching, and I hope you all have a good trading week.